you can move the needle in this business by having better store managers.
Domino's as a brand has become so strong in India that people have 3 apps on their phone. They have a Swiggy, Zomato and a Domino's app.
We are seeing a lot of companies, being contribution margin positive, even on just delivery as a channel.
If you create like a 150 million kind of top line business, you can create a company valued north of $500 million. Creating 1 or 2 loved brands is very tough.
The QSR business is fundamentally a model where you are trying to find standardization and replicability.
These are design choices for founders to think about, your menu, your pricing, etc. And all of these ultimately affect your throughput.
It's a very interesting space because it has good characteristics from both retail companies and FMCG businesses.
Food delivery apps for a QSR restaurant, right? Boon or a bane. Single brand QSR or multi-brand QSRs. Ready? Let's go. Okay, we dive deep. So you're looking at the camera, right? Hi. Should we take it again? Okay. Start. Hello and welcome to SummitUp by Elevation Capital, a series where we talk about the emerging themes and opportunities in the Indian startup ecosystem. Today, we talk about quick service restaurants, or QSR for short. And with me, I have Chirag and Vaibhav from the consumer team to talk about this space. Welcome to the pod, guys.
Thank you.
Thanks a lot, Vishy. It's great to be doing this with you. And it's a topic that's very close to our hearts, given Elevation has now been investing and tracking this sector for over 10, 15 years. And finally seems like a lot is changing and we are all seeing signs of QSRs mushrooming. So very, very excited to be chatting about such an interesting topic with you.
Awesome. I'm also glad to be talking about QSRs because my last couple of episodes were on space tech and then vertical fintech, and I had to pretend like I was understanding stuff. But I can safely say I've been eating food for a while, so I can talk a little bit more about this.
That's the beauty about consumer.
Absolutely. I love this. So QSR, right? Very interesting. I am old enough to remember when McDonald's launched in India, and it was such a, it grabbed headlines, and I remember making a beeline to going to one of the first outlets in Bandra and eating there, and that just seems like a different life and a different India, and we've moved a lot since then, right? And I think especially in the last few years, I've seen very significant mushrooming of not just global players coming to India, but also Indian QSR chains sprouting everywhere. Can we talk a little bit about what's driving the proliferation of QSR in India and where do you see this trend going?
So Vishy, you're actually right. The QSR market has been growing dramatically in the country. If you look at the 2005-2010 era, we were adding around 145 stores annually. Post 2010, there was a shift, orbital shift, and we started adding around 300 stores annually from 2010 to 2020. Post 2020, over the last 3-4 years, this number has reached 450-500 annually. So, of course, this segment has been expanding, and the pace of growth has also been expanding with every passing year. But the most interesting thing here is that even with such growth, it is still a massively underpenetrated category. So today, India stands at 3 QSR stores per million population, whereas this number for China in 2013 was 6, and today they are at 13. Of course, if we compare it with US, we are nowhere there because US, just as a consumer behavior of eating out for more occasions, even for functional meals, it is much higher. It is much higher there. But even if you look at some of these emerging markets like Brazil is at 40 stores per million population, so it is 10x India. So of course, there is massive headroom for growth just in terms of penetration. Another interesting thing happening is India is crossing this $2,000 per capita, GDP per capita number. And as we've seen this trend in other geographies also, that as the country crosses this GDP per capita of 2,000, more and more people start eating out for more occasions. It is not only an occasion-led, meal that they're having out, which is when the casual dining space expands. So up until now, casual dining had been the focus. It has, massively penetrated. But now with this GDP per capita threshold being crossed, consumers start eating out for more occasions. They start eating out for regular meals, for functional meals, etc. And QSRs become a huge spend pool now. So yeah, to sum up, QSRs have been growing massively over the past few years, over the past decade. But still there is massive headroom to grow just in terms of penetration. And of course, as the country grows richer, there is more discretionary income. QSRs become a key spend pool, as can be seen from other geographies and the trend of other economies. So very exciting times and an interesting space to talk about.
Very interesting. So I think this is the typical India story, massively underpenetrated, huge headwinds, some demographics, some behavior, some economics. So obviously, I think there is going to be a lot of excitement here, but there is also this very old belief that a lot of people have that restaurant business is probably the toughest business, right? So what makes us believe that QSR specifically is something that we think venture scale outcomes are going to get built? Why do we think it's an investable business?
Yeah, no, great question. So, maybe I can answer it in two parts. See, I think one, there is clear precedence of this happening in the past. So, if you look at a McDonald's, it's a 200 billion market cap business. Chipotle, which is a Mexican QSR, is at 90 billion. Starbucks, you can argue if it's purely a QSR or not, but let's say a branded food chain, 80, 85, 90 billion, somewhere in that zone. Now, these market caps are not small, even if you say, these are global businesses, but these are very comparable to FMCG. So let's say Coke market cap would be 250, 300 billion. Mondelez is 80, 90 billion. So it's not like these businesses end up being smaller than, let's say, packaged food or CPG. Now, let's understand why. So, as Vaibhav was mentioning, casual dining is where outside home food consumption starts. But, what's that use case? It's a birthday party, it's a dinner with your family, it's maybe a post office dinner meeting with a client. You are fundamentally seeking newer experiences and variety every time you go and do that. And therefore, so many casual dining places will come up. It is a market that is designed to be very fragmented because the customer is demanding newer, fresher experiences every time they go out. And that's why the restaurant business is also tough because, it's one part of the problem is establishing a value prop today, but it's even harder to sustain it over a period of time. On the other hand, if you look at the QSRs, the use case is a lot more functional. Speed is of essence. You're looking for going in for a quick lunch, getting a comfortable snack and walking out. Not people don't spend a lot of time sitting in these restaurants. In fact, how fast do tables turn is actually a very important metric for these QSR businesses. So what the customer is fundamentally looking for is, a consistent, reliable, fast experience over time. And therefore, the market lends itself very well for concentration. And therefore, there will only be 3, 4, 5 great brands in each subcategory within the food space. And that's what, that's why if you build a great brand, you accrue a lot of value over a period of time. Second, if you look at it from a very bottom-up POV, right, on how the financial metrics stack up. So, in fact, one discussion we keep having internally is that it's a very interesting space because it has good characteristics from both retail companies and FMCG businesses. So if you look at India retail story, right, we are all saying, there's massive headroom for growth. People will have a more income. They will go out more often. And therefore, there is a same store sales growth that keeps happening. You set up a store today. Next year, if your value prop is intact, you will do a lot more revenue from that same store. And that same store sales growth creates a lot of operating leverage because a lot of your costs are fixed in nature. You've signed rent is a fixed cost. Manpower, I would say, doesn't scale as fast as sales can, and so on. So same store sales growth keeps creating operating leverage in some of these businesses, which is the goodness of any retail company. And at the same time, QSRs end up being a negative working capital business. Now, Vishy, you've been at Unilever, you know the power of that distribution, right? Like when distributors pay you in cash and then you pay material suppliers much later, it's a extremely capital efficient model. And the same thing happens in QSRs because your customers walk in every day and pay in cash. And you are paying your vendors with like a 30, 40, 50 day credit period. So as the business scales, you actually generate cash versus consuming it. Versus any other retail category, you need to keep inventory in the store and then it will sell at a certain rate. So growth requires more capital. So as an investor, fundamentally these characteristics make it a very, very interesting business, and therefore we see these businesses also commanding great revenue multiples in public markets.
Interesting.
Just to add a little bit there, even if you see the Indian ecosystem, a lot of investor wealth has already been created. You look at your Devyanis, Jubilant Foodworks, Sapphire, Westlife. They are all the master franchisees for these global brands, right? Your Domino's, Burger King, McDonald's, etc. These people are all listed and they have been creating immense shareholder wealth over the last 5-7 years. And if I think of myself as an early stage founder, seeing some of these journeys already play out and create so much wealth, it is very inspiring for me. And as Chirag was mentioning, these businesses are fundamentally very robust. So even if you create like 150 million kind of top line business, you can create a company valued north of $500 million. And this 150 million revenue can be done quite easily in the top 10, 12, 15 cities. So if you think of it this way, this playbook is very replicable. And you can create a large outcome in a fairly short amount of time in a very capital efficient way, and hence it becomes a very lucrative business from an investment perspective also. Even there are a lot of Indian brands that are doing it, right? We have so many examples of companies that were started in the last decade in this space and who are creating a lot of value. We can take Chayos, for example, Wow Momo, there's Theobroma. So there are a number of examples, in the Indian ecosystem who have just started afresh, rode this wave and have created wealth for everybody involved.
One thing I wanted to add to the occasions for which people step out and eat, I think the most famous one for me is when I don't know what to tell the cook what to cook. So like, might as well solve that problem by stepping out. But yeah, you were speaking about the playbook, right? That Indian founders can sort of look to replicate as they start building out on QSR.
Yes.
Can you elaborate a little bit on what are some key aspects for founders to think about?
Yeah. See, I think the QSR business is fundamentally a model where you are trying to find standardization and replicability. Therefore, you have to think of the business as a box. Like there is a unit that you set up somewhere in the country, and this unit has to fundamentally work. Once you figure out what it takes to get that unit going, the model is very, very replicable. And then there are certain set of standard capabilities that need to be built, which we can maybe talk about later. But talking about those day one choices, right, of what you will need to see. So I think first you have to find, I'm guessing anyone starting out has a cuisine in mind, but then there are also several iterations you can do within that. So let's say you pick any cuisine. What use cases are you serving? What occasions are you trying to serve? Is it a lunch heavy menu or a dinner heavy menu? Even if it's a lunch heavy menu, can you do something to add snacks and so on and so forth? Those are the important considerations to think about. What I would advise founders is that, to simplify this problem statement, maybe one metric to think about is throughput per store, which is how much revenue can one unit do in 1 month. Let's maybe start with that problem statement. Now, throughput per store, the reason it is so important is because, as I was mentioning earlier, a lot of the costs in this business are fixed, and therefore, the higher your throughput, the more it helps your profitability, and it also helps you invest more into the business. So let's say your lunch business does a certain amount of revenue which generates money. You can plow that back into making a more elaborate store, putting in better fixtures, better furniture, so on and so forth. So the higher your throughput, the better you can make customer experience, and therefore that's worth solving for. And to solve for throughput, you have to think for your own category. How many people can walk into the store? What will be the average check size that each customer spends? Now, to solve for this throughput, maybe you can think of it as, number of people in a catchment that will come to your store. They'll come in at a certain frequency because of the use case that you're serving, and they will spend a certain dollar value, based on the meal and your proposition. So you have to sort of go deep dive into all of these three factors and do a lot of customer immersion, a lot of qualitative research to figure out what is the proposition I can build. You have to do it within some constraint, which is the menu can't be very elaborate. The brand has to stand for something. You can't really have a pizza place also selling biryani. I don't think that's going to work. So within the realms of your cuisine, if you can do a lot of customer immersion to solve the throughput per store equation, I think that really sets you up for success and can help you establish that early PMF.
No, I agree. And just to double click on that a little bit, when you're talking of optimizing your throughput per store, Chirag mentioned about number of customers who are walking in, what frequency they are coming to eat at, what is their average order value. If you think about all of these 2-3 levers, what are the design choices that you have to, affect these or impact these? See, one important thing becomes this cuisine that you are, operating in, or the menu design choices that you have. And if you look at global examples, you will be amazed to see, people actually tweaking cuisines and menus to affect one of these three things. I can take a live example, right? So McDonald's introduced McCafe. See, McDonald's in the US was always a lunch-heavy, carb-heavy meal. People used to come for lunches or, late dinners, etc. They introduced McCafe and the coffee offering so that people would come in the evenings also. So they were increasing the frequency. Also, there was certain senior citizens who did not have Coke with their meals. So they thought that these people will have coffee. So for the same TG, they were not increasing frequency, they were increasing the AOV. Because they were not having a Coke, they will have coffee. So you see these many menu design choices, tweaks, etc. to increase one of these three things, right? It's either your frequency or your AOV, etc. And these are things that are in your hand. So when you're thinking about your menu, when you're thinking about your cuisine, you should think about all of these things which can help you make better design choices. Things can go wrong also. For example, let's take the example of Dunkin' Donuts, right? So Dunkin' Donuts or any of these donut chains, where when they launched in India, they were perceived as a pastry shop because it's very sweet. It is a sweet offering. And pastry shops, you will go maybe once a week, maybe once in 2 weeks, because it's a very sweet offering. You're going there for some occasion. When you're coming back from office, you pick up a box of donuts and you reach home, etc. And they were neither able to get the right frequency, nor were they able to get the right AOV. So it was a little bit of tricky path. And then, they had to tweak their entire menu design. They brought in coffee, they brought in burgers, they brought in multiple other things to actually solve for a lot of these things. Similarly, to achieve throughput, another easy way out might be just reducing your pricing. Because you reduce your price, more people will walk in, frequency will increase, or the number of customers who are walking into your store, you're increasing that. Although your AOV may take a slight hit, but that is an easy lever to increase your throughput. Again, it has both pros and cons. So if you take an example of Starbucks, they launched this pico-sized beverages, very small. So they're actually reducing the pricing, but they are expanding the TG there. So it's very well thought through that, okay, there are some college-going kids who can't afford my coffee. They can commit with this lower priced point coffee. They will get hooked onto coffee and then they'll graduate to my higher priced coffee. So there's a lot of strategy going on there. And it is not negatively or adversely impacting the business. They've done it beautifully. It's a very tricky path, but they've done it beautifully. We can take the example of Pizza Hut, who actually, to compete with Domino's, launched a lower priced pizza. But there was no thought around who will be the TG, for what occasions will they purchase it. So what was happening was their same customer who used to purchase Pizza Hut was purchasing it for a lower price point now. So that brand image also took a hurt. Their actual throughput actually reduced because the number of customers was not increasing, the frequency was not increasing. So, these are design choices for founders to think about, your menu, your pricing, etc. And all of these ultimately affect your throughput. But there's no one right answer. There are all pros and cons for everything, and you have to be thoughtful, and every lever will have some impact on the business. So yeah, interesting ways to think about it.
Okay, that was very interesting. So a lot of things for a founder thinking of building in QSR to sort of think about. Clearly early PMF is going to be determined by throughput per store, and there are many levers to impact that. Smart menu choices that drives both frequency, high AOV, etc. Once somebody has figured out that sweet spot of a great throughput per store, looking to scale and figure out how to make that business a lot more defensible, what are some moats for a founder building in QSR?
Yeah, no, absolutely. See, I think maybe I'll cover how to scale this business first, and then we can come to moats. So see, once you found the right unit model, or which is this box, right, that works in one place, then you have to open 10, 20, 100 of them. Now, for that to happen, the number one problem is consistency of customer experience. And let's say the most critical part of the customer experience first is the food itself. So you have to get the food backend right. Now, what does that mean? You can't really have, skilled chefs operating out of all of these locations. A casual dining restaurant often markets itself on the name of the chef. There's a famous chef from some place. His signature style dishes are served here. A McDonald's cannot do that. So the backend has to be completely standardized, consistent across locations. Usually, we've seen two distinct models work well here. Number one is, people adopt a frozen supply chain where you're almost producing this product in a factory-like manner centrally, freezing it and moving it to all stores, which is where it is then heated, thawed, mixed with other ingredients and then served to the customer. So for example, let's say for McDonald's, the patty works in that way. And once you've solved that, then it's just burger sauces that need to be assembled. The other model is what is often called fast casual, which is, you don't need this frozen supply chain, but you are doing assembly of ingredients at the store itself. And these are often fresh ingredients. So, for example, if you've ever been to Chipotle in the US, what they would essentially do is that you have, let's say, all the ingredients like a corn, a chicken, rice, beans, etc., lying there in front of the customer, and you can sort of customize. Subway, in some way, is a very similar operating model where they procure fresh ingredients and then they would assemble there right in front of you. Now, in both of these models, you've solved for scalability to a very large extent because there is no longer a people dependence or a chef reliance to build your 100th store. Finding 100 skilled chefs is very, very hard, and it just can't happen. So let's say the food is sorted. Beyond that, you also need consistency of experience. The ambience has to look similar. There is economies of scale in procuring things. So all of that needs to be done centrally. So I would say broadly, operational excellence is a very key part of a very strong QSR business. And any company that is successful as a QSR, there would be a very heavy emphasis on just operational excellence, managing logistics, reducing wastage, centralized procurement. All of those would fit into that bucket. Really, at the core of this business is also a lot of people. In fact, through our experience of working with companies, what we've realized is that more than your corporate team, the business, you can move the needle in this business by having better store managers. They are really the ones running the show every day. They are the ones responsible for whether, people working in that store are motivated. They are the ones who can come up with ideas around, clever local marketing campaigns. They can give you competitive intelligence about what's happening in that micro market, what is the kind of customer coming in. So training that store manager is an extremely important problem. In fact, in some companies, we've often seen, stores that are not doing well. You put all your head behind it. Did we get the wrong location? Are we paying higher rent? What really went wrong? And sometimes the tweak is as simple. Just bring your best store manager in and he will solve that problem on the ground for you. So people training is an extremely important skill set. There has to be a heavy emphasis on training, on SOPs. How do you keep, people in the stores motivated? For example, if you look at Starbucks in the US, they are, very popular for having been the first company to offer health insurance to store staff. And, a lot of companies used to do it in the past, but they also gave it to part-timers. Now, that was beautiful because it improved their retention and reduced their cost of training. So what feels like an expense that now you're having to give, health insurance out to people, it was actually reducing cost because it brought down the churn in terms of store employees. So you have to keep people at the center of your thinking and invest in their training and employee satisfaction, and that solves a lot of problems in terms of scalability of this business. Lastly, I would say, there's one more very important piece of this puzzle, which is great business development. How do you be in the right locations? So because the reality is a lot of these categories are impulse purchases. Sometimes you don't plan to go to a certain food place. You just happen to be in an area around it and see this option, and it is a convenient place to go. So business development, which is finding these properties and being aware of it and setting up the stores, is an extremely important capability. Vaibhav and I often joke that capability is almost like running a VC business. When you start out, you have to see all the deals in the market. A lot of them will not work for you and you still keep saying no. But then there will come a point in time when you will know, oh, this deal that I have a gut to say this is 20% more efficient than the average deal, or this location will fit perfectly for a brand, and then you sort of go after it. So yeah, I think just to sum up, standardization of backend is very important. Operational excellence can become a strong moat. You have to keep people at the center, and business development again is a very important function for any QSR to build out over a period of time.
Yeah. And just to add one more thing, as you scale up, this brand starts becoming a moat. I personally believe that, if there are two Mexican outlets in front of me, a Chipotle and a Taco Bell, I will choose one of them to walk into, and it will mostly be because of the brand I associate more with or the affinity I have towards the brand. But yeah, every customer develops an affinity for a brand. And, it's not intangible. see, if your brand becomes stronger, I can take the example of Domino's in India, right? If Domino's as a brand has become so strong in India that people have 3 apps on their phone. They have a Swiggy, Zomato, and a Domino's app. And usually you order on the Domino's app because you know it'll be fresher or whatever it is. You just have that affinity towards that brand. And because of the direct order, Domino's does not have to pay a lot of commission to these food aggregators, and it can get more money to reinvest in brand again. So this flywheel keeps on rotating, and as you become larger, this brand image that you've developed becomes a very key moat, in my opinion. And when I say branding, I don't mean that you spend a lot on branding, right? Typically, you see QSRs will not spend more than 3 to 5% of revenue on branding. Compared to some other new age digital sectors, this is peanuts. Because as Chirag was saying, it's a box model, right? It's micro market focused, etc., etc. So you don't need to spend a lot on branding. It's about doing the simple things right. And with enough consistency, you start creating a brand that people start loving. And that can become a huge, moat in the long run, when you're looking at a scaled company. So for me, I think just to add one more point, branding can also become a moat.
Yeah, brand is the outcome of everything else you do versus something you can solve for.
Nice. Okay, so that's a great segue to my next section, Vaibhav, because you set me up for it. When we were talking about Domino's and their ability to have moved away to a little bit of their dependence on delivery apps, right? So I have a bunch of questions which I'm guessing would be key consideration for anybody thinking about this, and I'm gonna pop them across you one by one. So the first one is food delivery apps for a QSR restaurant, right? Boon or a bane?
100% a boon. There's no doubt about it. See, one, as we were mentioning in the beginning, right? The sector is now at an inflection point. I think food delivery is one reason it is at an inflection point today. Because what food delivery essentially does is that, let's say if someone wanted to build out a Mediterranean chain or even the coffee businesses or the beverage businesses for that matter, because food delivery exists, you can now set up a lot many more stores versus what you would have been able to do without it. Let me explain why. Let's say the building blocks of your business are such that you sort of break even at a store level at, let's say, 10, 12 lakhs of revenue. Now, maybe half of that can come from food delivery. And, that food delivery order can also come from 5 kilometers, 6 kilometers away. The dine-in customer is very unlikely to come from 6 kilometers away. And therefore, I actually feel a lot of the proliferation we are seeing in terms of new cuisines is because entrepreneurs trying to get into newer formats of QSR are now able to set up their businesses and let the brand grow. You start out in a location, your dine-in footfall will keep growing at a certain same-store growth month on month. But delivery revenues can come from day one, and that gives you a lot of base in some way to start covering your costs and therefore be a lot more experimental. So 100% a boon, and will keep helping companies down the line. The reason why a lot of people feel negatively about it though is also intuitive, which is that it comes with an added cost line item, which is commissions. Now, see, you have to be smart about it. And figure out how to price your products, how to change the menu in a way that even the delivery economics start working for you. But it is possible to do that. We are seeing a lot of companies, being contribution margin positive, even on just delivery as a channel, and scale beautifully. One thing to be mindful of though is that the food delivery revenue pools are capped at a city level. So let's say in a city like Bangalore, maybe you need 40 outlets to be 3 kilometers away from any customer in the city. Now, if you go from 40 to 100, it's not like your volumes are going to grow many-fold. So maybe somewhere in that journey, your dine-in proposition independently has to work. And I would say dine-in can still scale irrespective of how many locations you are in, because it's very impulse and sort of more micro-market heavy nature, micro-market focused in nature versus the delivery brands. So that's the only thing to keep in mind as you scale with a mix of food delivery and dine-in, but 100% a blessing in disguise for food entrepreneurs.
Very clear. Awesome. One for you, single brand QSR or multi-brand QSRs?
I think this is slightly one of those tougher ones, with not a very clear answer. I think, see, what are multi-brand QSRs? Multi-brand QSRs are one of those cloud kitchens through which you can serve multiple brands. why do people want to do multi-brand QSRs or multi-brand cloud kitchens? See, the thinking is the customer is eating 3 to 4 times outside his home. Once he will go for a dessert, once he will want to have a biryani, once he will want to have a pizza. So you can't just serve one cuisine and satisfy or create a large business. You need to have that one kitchen that serves all of these cuisines so that you can capture maximum wallet share of the customer and build a large business. So that is the entire thinking behind why you need multi-brand cloud kitchens, etc. And of course, it has its own advantages, right? Because as we were talking about optimizing for throughput per store, or in the cloud kitchen model, it will be throughput per cloud kitchen, right? So with biryani, you can do maybe X lakhs. You add pizza on the same infrastructure, you can do X more lakhs. Then you add dessert on the same infrastructure, you can do X more lakhs. So your throughput per cloud kitchen is theoretically increasing. And it has its own advantages. All of those, you don't need to invest in a larger space. Of course, after a point of time, you get capped out. Yeah. But these are all these advantages of running multiple brand QSRs. But if you look at it from the customer point of view, there are no synergies. So if I'm scrolling through Swiggy, I don't know if this biryani and this pizza is going to come from the same place. And for me, those are two separate brands. So when I want to eat biryani, I will compare the biryani brand with 10 other, maybe only single biryani brand QSRs. And you have to capture mind share there. You have to pop up there with your own biryani value prop. And when I'm doing pizza, I will compare you with your Domino's, Pizza Hut, etc., other single brand pizza places. And you have to again spend the same amount on marketing or, capture customer share in the same way there as well. So while there are advantages on the backend side and theoretically, financially, it should make sense, from the customer side, there is limited synergies. And Chirag and I and, we at Elevation believe that creating one or two loved brands is very tough. Brands that have that customer fandom, there is strong following, there is a lot of love. It is very tough. So creating multiple such brands is a very tough journey anyway. Maybe these multi-brand QSRs or multi-brand cloud kitchens can be sort of an experiment where you find out that one brand that is working very well for you, and then you double down on that. So yeah, as I was saying, not a very clear answer. Both are yes and no. There are pros and cons, and maybe one of these founders will come us and tell us how it is to be done.
Outstanding. Interesting. Okay. Vaibhav continues to sit on the fence. One last one for you. Owned outlets or franchise models as QSR scale?
Got it. So, different answer for different stages of business. If you look at all the listed companies in India, which Vaibhav mentioned, Jubilant, Westlife, Sapphire, Devyani, they're all, India master franchisees of global brands. Now, the reason those brands choose to operate in this manner in India is because you really have to be in the market and get a pulse of it to run a business which is physical in nature, so many stores, so on and so forth. Even getting licenses in India is non-trivial. You need to manage people. You need different sorts of permissions. It's a ball game where you need local expertise to operate this business. But what the global brands have done is that they have found one Indian company or two in some cases to run their pan-India business versus, let's say, an approach where you have thousands of franchisees running this business for you. In fact, Subway in India used to operate in that model in the past and is now sort of transitioning. Our view is that, for global brands, this master franchisee model will continue to be the way to operate in India. And it makes sense to pick one or two meaningful partners who can build this business pan-India for you. And the same thinking should apply if a startup at some point is trying to go international, where they should, find some meaningful partners and let them build the business in those geographies. But let's say for a startup in very early stage, less than 20 stores, less than 100 stores even, in our view, we feel the company-owned, company-operated model is the way to go. Between company-owned, company-operated is a lot more critical. Not doing that takes away from customer experience. In the franchisee business, you're dealing with an entrepreneur who has to manage his own P&L. Therefore, there might be periods where you are taking a long-term call, but that person has to optimize for the short term. Their ambition, their working capital conditions, their cash flow requirements, put your destiny at their mercy. And all of these things, affect customer experience and the scalability of your business in some way. So company operated, we feel, is like a non-negotiable if you are in early phases of building a brand, which you want customers to love. The company owned part, I think, it's almost like thinking of it as a source of capital. So if you have equity capital or access to debt, again, and the business model works where each unit sort of generates money, then we don't see any reason why you have to sort of give it away to a franchisee. I mean, for a company that is able to generate healthy economics, bank debt will structurally always be cheaper than getting another entrepreneur in who has to make more than his cost of capital. So we feel company owned is a capital allocation call. If your economics work, it's always better to do it in house. And company operated, let's say till the time you're a well loved brand, is almost a non-negotiable factor if you're trying to build a brand that customers love.
Understood. Super. So now to those founders who are looking to scale up through the company-owned model and hence are looking for venture investments, we clearly have a very clear thesis and a point of view on what it takes to succeed in this space. What would be your advice to founders building over here? What do you see are markers for us as Elevation to be interested in their business?
So I think to any founder starting to build in this space, I think one thing we at Elevation look at is whether it is a QSR business or a casual dining business. Right, QSR businesses are very scalable. Standardized backend, supply chain is sorted. You can open more stores rapidly and grow from there. So it is very important to be a QSR business versus a casual dining business. And once you've identified that it's a QSR business, then that golden metric that we've been talking about, throughput per store. Because this one metric tells you everything that you want to know about the business, from whether the customers are accepting it, how much are they willing to pay for it, how will your economics look down the line, etc., etc. So yeah, for founders who are looking to build in this space, these are the two things that you should keep in mind, and these are the two things that we also look at when we are evaluating businesses to begin with.
I'll just add a few more things. I think, if you're building in this space, what we would like to see is, maybe execution in some micro market or even in one city, but with a lot of customer love and with a very clear playbook sort of emerging. I don't think we are necessarily looking for businesses that have scaled so much that we have evidence to say it works in Bombay and in Delhi and in Bangalore, but it works in a city. This is the clear operating model, and this is the playbook that is emerging in terms of what use cases do we cater to. Therefore, what kind of properties do we identify, and what do we do in the store. I think it's that clarity of thought which we try to dig into when we meet entrepreneurs in this space. I can also share learnings from Chayos, right? Given it's a company we've had the privilege of partnering with for so many years. See, I think Nitin and Raghav, both super customer obsessed entrepreneurs. The amount of time they spend in the stores, even when the business is 150, 200 stores, is just insane. And that I think is very, very critical because the market and consumer behavior is evolving very, very fast. So in early days, for example, we felt no one walks out of their home thinking I'll go to a Chayos, and therefore Chayos stores need to be in high footfall areas, and that's how we cater to this audience. Today that behavior is changing. We are seeing very different sort of personas come into the stores. So many startups are getting built out of Chayos now, which is very interesting to see. At the same time, the way the business development function runs, there are very clear guardrails on what rent per square feet can be open, what are the type of properties we are going after. It runs methodically versus out of the whims and fancies of someone running that business. So I think there has to be inordinate amounts of empathy towards customers, obsession about understanding and iterating on some of these behaviors, and at the end a realization that this business has to scale like a playbook versus through very opportunistic decisions. I think if we are able to see those things in an entrepreneur, we are very, very excited to partner with them along the way.
Okay, thanks, Chirag and Vaibhav. That was a very interesting conversation. I think we're ending on a good note. You whetted my appetite. I think it's time for us to step out and grab some food. But if you're a founder who's been watching this, if you are building in QSR or are interested in the space, I'd urge you to reach out to the team, and we'd love to hear what your thoughts are about building in India in the QSR space. Thank you.
Thank you, Vishy.
Thank you.